1550. By that year, prices inside Spain had already started moving upward. Not slowly, noticeable. Food cost more than it did a decade earlier. Rent increased across cities. Daily expenses climbed faster than wages. Nothing dramatic had happened politically. No major reforms, no currency change. Yet money inside the economy was behaving differently. Silver coins were everywhere. Markets had liquidity. The state had cash to spend. But the economy itself wasn't producing more goods. Output stayed almost flat, while currency in circulation kept increasing. Between 1500 and 1650, prices in Spain rose close to 400%. Wages rose only around 150%. That gap began reshaping everyday life. Workers spent faster because holding money made less sense. Merchants adjusted prices constantly. Savings lost value year after year. From the outside, Spain still looked powerful. Coins flowed through the system. The treasury wasn't empty, but internally, purchasing power was eroding. This wasn't a crisis yet. It was a slow distortion. Money was no longer reflecting real production. It was reacting to volume. And once that imbalance enters an economy, it spreads through prices first, then through behavior, then through institutions. The source of that imbalance didn't come from inside Spain itself. It entered from outside, suddenly, repeatedly, and in massive quantities. By the mid-16th century, Spain was not creating this monetary pressure internally. It was importing it. The turning point came from outside Europe, from territories Spain had recently brought under its control. In 1545, a silver deposit was discovered at Potosí, in present-day Bolivia. What made this discovery different was not just its size, but its scale, relative to the global economy of that time. Potosí was not a normal mine. It was a mountain filled with silver, and within a few decades, it became the single largest source of silver in the world. Along with other major mines in Mexico, Spain now controlled close to 60% of global silver production. Every year, vast quantities of silver were extracted, minted into coins, and shipped across the Atlantic. Historical records suggest that by the late 1500s, Spain was receiving anywhere between 150 and 300 tons of silver annually. For comparison, this was not marginal inflow. This was a structural shock to Europe's entire monetary base. Silver was not treated as a strategic reserve. It entered circulation quickly. It was used to pay soldiers, settle taxes, finance wars, and purchase goods from other European economies. The velocity of this silver mattered as much as its quantity. Money was not sitting idle. It was moving constantly through markets. The problem was that Spain's domestic economy was not expanding at the same pace. Agricultural output did not multiply. Manufacturing remained limited. Spain relied heavily on imports for finished goods. So while silver flooded the system, the supply of goods stayed relatively constrained. From a financial perspective, this created a classic imbalance. Money supply expanded rapidly, while real output remained largely unchanged. Under those conditions, prices do not stay stable. They adjust upward to absorb the excess liquidity. What made the situation worse was the consistency of the inflow. This was not a one-time event. Year after year, silver continued to arrive. Markets adjusted, then adjusted again. Price increases became normalized rather than alarming. At this stage, Spain did not appear fragile. The treasury had access to funds. Trade continued. Military spending increased. But the economy was now anchored to a monetary source that was external, volatile, and disconnected from domestic productivity. That dependency would shape every decision that followed. As silver continued to circulate, the imbalance inside Spain's economy became harder to ignore. The amount of money moving through markets was rising every year, but the amount of goods available for purchase was not increasing at the same pace. When that happens, prices become the adjustment mechanism. This period later came to be known as the price revolution, but at the time, it did not feel like a single event. It felt gradual. Between 1500 and 1650, the average price level in Spain rose by close to 400%. Over the same period, wages increased by only about 150%. That difference mattered more than any single number. It meant that even though people earned more coins than before, those coins bought less every year. For workers, this showed up first in basic expenses. Food absorbed a larger share of income. Rent became harder to manage. Daily necessities started consuming money that would earlier have gone into savings. The problem was not unemployment. The problem was purchasing power. Merchants adapted faster. Prices were adjusted frequently, not because of greed, but because replacement costs kept rising. The trader who sold goods at old prices would not be able to restock at the same cost. Inflation forced constant repricing, which made long-term contracts unreliable. For people who saved money, the impact was more subtle but more damaging. Holding silver no longer preserved value. Saving became a losing decision. Money lost strength simply by sitting still. As this pattern continued, behavior changed. People spent faster because delaying purchases meant paying more later. Borrowing began to feel less risky because future repayment would be made with weaker money. Debt stopped looking dangerous and started looking practical. From the government's perspective, this environment felt manageable. Tax revenues rose in nominal terms. Silver inflows continued. The state had access to liquidity. On paper, the system appeared functional. But inflation was quietly rewriting incentives across the economy. It rewarded spending over saving. It rewarded borrowing over restraint. It pushed decisions toward short-term convenience rather than long-term stability. This is the critical point. Inflation itself did not collapse Spain overnight. What it did was change how every participant in the economy behaved. Once that shift takes place, the system becomes fragile without looking weak. And this new behavior would soon collide with how the Spanish state chose to spend its money. As inflation continued to reshape behavior inside Spain, another change was happening at a broader monetary level. The value of silver itself was shifting, not just within Spain, but across Europe. Before the mid-1500s, silver had been relatively scarce. Its value was stable because supply grew slowly. One way the stability showed up was in the gold-to-silver ratio. For long periods, 1 unit of gold was worth roughly 12 units of silver. That ratio reflected scarcity and demand. As silver production accelerated, that balance began to break. By the late 16th century, the ratio moved toward 15 or 16 units of silver for 1 unit of gold. This change did not happen because gold became more valuable. It happened because silver became more abundant. From a financial perspective, this was dilution. The metal that functioned as everyday money was losing relative value as its supply expanded faster than demand. Estimates suggest that silver's purchasing power declined by roughly 25 to 30% over this period, even before accounting for local inflation effects. This mattered because silver was not a passive store of wealth. It was the medium of exchange. Wages were paid in silver, taxes were collected in silver, contracts were settled in silver. When its value weakened, the entire pricing system had to adjust. Gold, by contrast, remained concentrated in treasuries and elite holdings. It did not circulate at the same scale. Its relative stability made the divergence even more visible. Two metals existed side by side, but only one was flooding the economy. As silver lost value, it took more of it to buy the same goods. This reinforced the inflation already present and made price increases feel constant rather than temporary. The problem was no longer just rising prices. It was the erosion of the unit used to measure value itself. At this stage, the monetary system had become highly sensitive to continued inflows. Stability depended on silver arriving regularly and in large volumes. Any disruption would not just slow growth, it would expose how much of the system had been built on a weakening base. That dependence was about to shape how the state financed its next decisions. By the late 16th century, Spain's economy had adjusted to a new normal. Silver inflows were no longer seen as exceptional. They were expected. This expectation quietly reshaped how the state managed its finances. The Spanish crown was operating an empire that stretched across continents. Maintaining that empire required constant spending. Armies had to be paid, fleets had to be built, administrators had to be supported, and wars had to be fought far from home. All of this required cash, not promises. On paper, Spain appeared capable of meeting these costs. Silver continued to arrive, and nominal revenues looked strong. But inflation had already weakened the real value of those revenues. Taxes collected in silver did not stretch as far as they once had. The state needed more money just to maintain the same level of activity. Raising taxes domestically was not an easy solution. Much of Spain's internal economy was already under strain. Productivity was low, manufacturing was limited, and inflation had reduced the real burden that existing taxes could support. Increasing tax rates risked social unrest without guaranteeing sufficient revenue, so the crown turned to borrowing. European banking families, particularly in Italy and the German states, were willing to lend. Spain was considered a reliable borrower, not because of its domestic economy, but because of its access to future silver. Loans were extended against expected shipments that had not yet arrived. In effect, tomorrow's silver was being spent today. This practice quickly became routine. Borrowing was no longer reserved for emergencies. It became part of normal fiscal management. As long as silver continued to flow, debt appeared manageable. Interest payments could be met, and new loans could refinance old ones. From a financial standpoint, this created a dangerous structure. The state had liquidity, but its solvency depended on uninterrupted inflows. The balance sheet looked strong in nominal terms, but it was fragile underneath. Any delay, disruption, or decline in silver shipments would create immediate pressure. At the same time, inflation made borrowing feel cheaper than it actually was. Future repayments would be made with weaker money, reducing the real burden of debt. This encouraged larger loans and reduced caution. The discipline that normally limits state spending was softened by the belief that silver would cover future obligations. Military spending accelerated under these conditions. Spain committed itself to prolonged conflicts across Europe and beyond. These wars were expensive and continuous, absorbing an estimated 60 to 70% of state expenditure at various points. The scale of this spending would have been difficult to sustain even in a healthy economy. Instead of adjusting strategy or reducing commitments, the state leaned further into debt. Loans filled the gap between rising costs and eroding revenues. The financial system became increasingly circular. Silver arrived, debts were serviced, new debts were issued, and spending continued. This did not immediately look like failure. Payments were made, armies marched. The empire functioned. But the margin for error was shrinking. The entire fiscal structure was now tied to a single assumption that silver inflows would remain large, regular, and sufficient. Once a state reaches this point, flexibility disappears. Decisions are no longer made based on long-term capacity, but on short-term cash needs. Policy becomes reactive rather than strategic. Spain had not collapsed. It was still powerful, but its financial system was no longer resilient. It was balanced on continued inflows, rising prices, and growing debt, with little room for disruption. The first real test of that structure was approaching. The first real test did not come from a single disaster. It came from pressure accumulating faster than the system could absorb. Silver shipments did not always arrive on time. Some years, production slowed. Some shipments were delayed by storms, piracy, or logistical failures. Under normal conditions, these would have been manageable disruptions. Under Spain's financial structure, they became serious problems. Debt obligations, however, did not wait. Interest payments were fixed. Military expenses were ongoing. Administrative costs continued, regardless of how much silver reached port. When expected, inflows failed to materialize. The gap between cash needs and available funds widened immediately. This is when Spain's financial weakness became visible. In 1557, the Spanish crown suspended payments on its debt. It was not the last time. Similar defaults followed in 1575, 1596, and again in 1647. These were not symbolic events. Each default forced emergency negotiations with creditors, restructuring of loans, and temporary freezes in state payments. From a financial perspective, these were sovereign defaults. The richest empire in the world was repeatedly unable to meet its obligations on schedule. Each crisis followed the same pattern. Spending commitments remained high. Silver inflows were assumed. Borrowing filled the gap. When inflows disappointed, the system snapped. Creditors became more cautious. Interest rates rose. New loans required harsher terms. Servicing existing debt consumed a larger share of incoming silver, leaving less available for actual governance. At the same time, inflation had not disappeared. Prices remained elevated. The real cost of maintaining armies and fleets continued to rise. Even when silver arrived, it solved fewer problems than before. What made the situation worse was that alternatives were limited. Spain had not developed a strong domestic industrial base that could generate independent revenue. Trade deficits persisted. Imports drained silver outward almost as quickly as it arrived. By the early 17th century, the empire was still functioning, but the financial engine driving it had lost stability. Each year required more money to achieve the same results. Each disruption carried greater risk. The system no longer failed suddenly, it strained continuously. And that strain began to reshape Spain's position in the wider world. By the early 17th century, Spain was still an empire on maps. Its flag still flew across continents. Its ships still crossed oceans. But economically, the system that powered that expansion had lost balance. Money was no longer anchored to production. State spending was tied to future inflows rather than present capacity. Debt filled gaps that silver could no longer close reliably. What made this situation dangerous was not a single mistake, but a structure that required everything to go right every year. As long as silver arrived on time, the system functioned. When it didn't, pressure surfaced immediately. This is how economic decline usually looks. Not dramatic, not sudden, just increasing strain year after year. And once that strain becomes normal, the outcome stops being a surprise.